Well, I fit in really well in my suit and tie.
Should have come barefoot. We're right on the beach.
I like that. I like that idea. I would feel more comfortable.
Feel free to take them off. So you took over as CEO at Schwab October 1st, 2008. So this is right in the thick of the financial crisis.
It was.
Looking back between then and now, what strikes you as some of the biggest differences? What's different about today versus then?
Well, one thing that's different is I was able to successfully have the stock price my first 90 days, and yet I survived. So that's probably it. But the consumer has changed, understandably. Coming out of the financial crisis, there was a real loss of trust. And as a result, we see trends across all of the investing industry that are still manifesting today. The movement into passive investing. In other words, the consumer saying, I want to understand what I'm putting my money into and what the likely outcomes will be. A much greater awareness of costs and the importance of costs and the drag that they create on investment performance. Even consumers diversifying away or believing that diversifying by putting money with a number of different providers is a form of diversification. At the core of really all of it is just trust and the impact that the financial crisis created in terms of lack of trust.
One change that's happened in the past few years is you've been in a bit of a price war with some of the other brokerages on the market. You've now cut Schwab's trading commission fee to $4.95. Some people think that you could cut it further. Even the CEO of Robinhood, which charges 0 trading commissions, has said that all commission fees might eventually just go away. Actually, we have a video, so let's take a look.
There's a couple of things that are going to happen when the brokerages start lowering their prices. One is that they're going to have to get more efficient, which is going to be challenging because they've been sort of operating under this principle that they can charge exorbitant fees for decades now, and that's just led to not the same focus on efficiency that a tech company would start out with.
So what do you think is more likely? Will you go below $4.95, or maybe Robinhood will have to start charging commissions?
Well, let's not kid ourselves. Everybody's paying. Nothing is free, whether it's trading a stock or staying at this wonderful resort. Nothing is free. It's just a matter of how you pay. And certainly, if you are an account holder at a firm that is charging a 0 explicit commission, you're just paying in other ways, whether it's in yields on cash, whether it's in the quality of the execution. We're all paying because nothing's free. Now, granted, if you are operating under a model with venture capital subsidizing your operations, you can drag that out for a longer period of time in which you maybe charge less than you need to be a profitable organization, but everybody's paying. I think the real question is the question of subsidization. And where will consumers go, and where will innovation go in the financial services and investment space in terms of rooting out subsidization? And in many ways, I think it would be healthy for subsidization to go away across our industry. And so the consumer would be in a better position to know exactly what they're paying, what they're getting in return for it. But today, the whole industry is rife with that. One thing I would just comment on, there's certainly some validity to some of the comments from the gentleman from Robinhood, but ultimately scale and efficiency do matter. And I'm assuming he's not necessarily referring to Schwab when he talks about inefficiency. I mean, we run our firm on about 16 basis points of cost relative to client assets. That's about half our next closest publicly traded competitor and about a third of most of our more traditional competitors. So scale matters, costs matter, because ultimately it puts you in a position to have to subsidize less and leaves more money back in the pocket of the consumer. But I think the real question is, where do we go with subsidization, which has always been a big part of our industry.
What does that look like at Schwab if subsidization were to go away?
Well, you just move to a world where everything that the consumer does, and every activity, every transaction, advice, counsel, financial planning, all of that is is priced appropriately for the service they're receiving, and nothing is overpriced or necessarily underpriced. We're a long way from that in the industry overall. I'd hazard to guess that there might only be one firm who can do a trade at a lower cost than we could in the industry, just based on our scale and size. And even as large as we are, with almost $3.7 trillion in client assets, it's not a cost of zero to do a trade. I mean, there is a cost. So it's just a matter of how it's being paid.
Which firm is the one that can do it cheaper?
Well, TD Ameritrade has the highest volume of trade count. So I don't know their math, but I'm assuming that they would have some very minor advantage of us in terms of the cost of trades. But again, we're talking about very, very low numbers in terms of cost. We do, of course, tens of millions of those of trades every year.
So you're kind of at the floor then, where, in terms of how much you can lower your costs, or can you lower them further?
Well, I don't think pricing is necessarily done explicitly on cost. Pricing is done based on market, right? I mean, I like to say that the market sets price, whether we're talking about the cost of a trade, the cost of advice, your salary. I mean, market sets price. And as competitors in the marketplace, we all have to respect and recognize that if we want to be successful businesses, that we operate within that market. So I don't think a $4.95 price point is going to be driven purely off our cost of doing business, but it's going to be based on market forces.
Speaking of some of the new fintech companies that have come into the space, there's also robo-advisors. Actually, in the next session, we'll have the CEO of Wealthfront, a robo-advisor that now competes with you. But you also have your own, okay, but we also have your own, you have your own robo-advisor, Schwab Intelligent Portfolios.
Yeah.
I think it's still about 1% of your overall assets, and about half of your assets are managed by human advisors. So in the end, who wins, the robots or the humans?
Yeah, so just for clarity, probably about half of our assets are under some form of advisory relationship, but all of those are a mix of technology and people. None of it is pure people. I think the consumer probably wins at the end. Models like a Wealthfront or a Betterment do better for consumers than many consumers could get from an investment advisory model in years past. So I think the consumer wins there. I think programs like our intelligent portfolios do better than consumers could typically get in years past. I mean, it's amazing for me to think about the idea that somebody with just a couple $1,000s can get a fully diversified portfolio, rebalancing, tax loss harvesting, and have an all-in cost, at least under our program, that's probably measured in a couple tenths of a percent. That's amazing. Maybe it's just because I'm old and been in the business 37 years, but you couldn't even get that 25 years ago, and 10 or 15 years ago, it probably cost you 75 basis points or maybe even 1%. So I think the consumer is the ultimate winner. In terms of smaller firms starting up in the digital advisory space, this issue all just comes down to time frame. What is the time frame you're playing on? It's not a matter of, I think, within the companies who wins and who loses. We're playing a long time frame. I mean, we bring in more net new assets every month than those firms have in total. So it's just a different time frame. If your business is financed by VC, there's an exit strategy, and so the time frame might be until they're acquired, and I'm not saying any of these firms are for sale, but until they're acquired or until some other transaction takes place. That's not our time frame. We're playing a multi-decade time frame and investing and trying to build our business under that. But the ultimate winner in all this is the consumer, and frankly, that's great. That's how it should be.
In a moment, I'm going to open it up for questions. So if you have questions, raise your hand. We'll get a mic to you. But first, in terms of all the new assets that are coming in, speaking of the Wealthfront CEO, he said before that Schwab doesn't have any millennial customers. I don't think that's true anymore. But can you talk about how you're trying to win over millennials?
Yeah, so about 53% of our new-to-firm households are millennials. And we bring in, of course, close to 500,000, 400,000 to 500,000 new households every year, adding to a base that's measured in many millions. So the idea that we're not winning with millennials, of course, is just factually inaccurate. But what's really important is it's not just any millennial. The average millennial that we're winning has a level of affluence that matches our existing client base.
Oh, wow.
So our average retail household today has in the vicinity of $350,000. So the average millennial we're winning has that level of affluence today already. So in terms of winning with millennials, specifically to your question, our philosophy has always been that the winning strategy is one that works for all investors. That it's not a matter of saying we're going to just do this for millennials. We have many clients at all different ages utilizing our mobile app, our mobile technology, don't ever call into any of our service centers. But you do have to recognize that the world is changing, and if you're not changing your model, you will probably be in some challenge for growth out into the future. One last comment. The economics of our business are driven by Gen X and boomers, and we shouldn't forget that. Certainly for the next 30 years, that's where the economics will come from. Now, if you're over-rotated to a shorter-term time horizon, you could make a mistake, which is why, again, we're focused on multi-decade. We need to win millennials, but the economics are driven by X and boomers. But I think our success with millennials speaks, I guess it just speaks for itself as I share with you metrics.
Yeah. Did we have a question back here? Oh, there's one here. If you could bring the paddle, please. And please tell us who you are when you...
Hi, I'm Schwab. I'm an investor and I'm a venture capitalist that invests in fintech. Do you see the products basically serving a consumer that's going to evolve, as in the customers that are being served by some of the fintechs as being less sophisticated, if you may, because of lower asset sizes, and that they would actually need different products as they graduate and become more affluent as they grow?
Yeah. When I went to my first job interview, that polyester leisure suit I wore is really cool. It's probably not the same suit I wear today. And the four-door Ford Maverick I drove is a different car. People's life changes, needs evolve. That's not to say that a company that works with a consumer as a millennial won't consider that company in the future. But I think that we're always constantly, as consumers, evaluating the range of options available to us. We're not just saying, well, I've always driven, I drove a Ford Maverick when I was 21, so I'm always going to drive a Ford. You're going to constantly look at your options available to you. Now, I might have a particular affinity to the brand or something that I started with, and they might start from an advantaged place, but I don't think it assures success. Now, I will say the experience is something totally different. When you move into the experience, if I have the experience of working maybe with a 100% digital model, I'm not going to probably consider another model that doesn't offer me comparable capabilities. But if they offer me comparable capabilities and then something in addition, that I think is going to be very appealing. And I think that, again, the math proves that out.
Keep raising your hands if you have questions, and we'll get the paddle to you. But I have a follow-up question. In terms of the millennials who are coming in and this younger generation, are they going into the robo-advising product? Are they self-directed, or are they actually opting for human advice?
So our research indicates when it comes to digital advisory that it's less an issue of age than it is their prior form of investing. That investors who are previously self-directed are much more likely to consider a digital advisory program than it being defined based on age. Millennials, what they do with their money as they come into Schwab, if you were to map out and lay beside millennials and Gen Y and Gen X and boomers, they don't look very different. Boomers are a little more dependent on a form of discretionary advice, but the behavior of millennials, now bear in mind, we're attracting fairly affluent millennials, is actually quite consistent with other generations. They're not behaving in some dramatically different manner.
Interesting. Question over here, please. Please introduce yourself.
Yep, hey, Walt. Scott Ruddle with Accenture. So I'm curious, as you talk about all these different trends and how your business has really evolved in terms of how you service clients, how have you thought about the Schwab brand and kind of both maintaining that and appropriately evolving it to some degree?
Yeah. Well, it's interesting. I mean, I think our view is that although brands are important, on a relative basis, they've probably never been less important. And this probably all plays into the trust issue that we started off with, thinking back to the financial crisis. What we say about ourselves is not very important. What really matters is what others say about us. And the great thing about that is it means that if you're saying one thing in your business and doing something else, the marketplace will call that out, whether it's a combination of press, social media, and that's a good thing. So from a brand standpoint, I think what's most important for us, the way we view it, is we just need to ensure that we act in a very consistent manner in what's in the best interest of our clients. Now, we have to make money. We all know that. But within the constraint of being appropriately profitable and able to reinvest in our business, we just have to always make sure we do the right thing by clients. And I think our view is if we do that, the brand will continue to grow and be successful. And again, I hate to keep going back to it, but the math backs it up. Bringing in hundreds of thousands of affluent millennial clients every year.
One more question over here.
Oh, you got cut out, Adam.
Hi, Brian Domain Fortune. Are there any non-traditional competitors that you worry about? I mean, globally, I think about Alipay, and they've got a money market fund that's small compared to yours, 200 billion or so. But is there anyone going to come out of left field that might keep you up at night?
I mean, I think we're paranoid. We worry about everybody. We try to pay attention to everyone. Certainly the regulatory environment here domestically creates a fair number of barriers for folks to want to go fully into our space. And of course, I think we see that going on even in the moves today, or the move announced yesterday.
Facebook Project Libra.
Sure, with our friends at Facebook. I mean, the efforts today are largely to figure out ways to make the space more efficient without running headlong into the regulatory world that we live in the US. I heard some of the comments in the last session about lending and how crazy it is that it takes 60 days to do a mortgage and all that. Well, so much of that is regulatory related. But I think we pay attention to everyone. Whether folks will want to go fully into our space, I'm not so sure, but they'll look to pick off places. And that plays back to the comments I made at the outset around subsidization, right? Technology, innovation, disruption ultimately attacks subsidization. And so that's where we believe ultimately we'll head in our industry, is that you just won't be able to subsidize one product or service with another.
I assume you were asked to join Facebook's Project Libra, but neither you nor any other bank is doing it. Why not?
Let's answer that question out in the future a little bit.
Can you talk a little bit about, just your view on cryptocurrency? I know there's been rumors that even TD Ameritrade might start trading it. Is that something you've considered?
Well, sure. I mean, you just want to make sure that if you're going to offer the trading capability to the retail investor, which is the majority of our clients, retail end investors, that you're doing something that will be consistent with your brand and not just about making money. Could we make money doing that? Of course we could. But then again, I probably get 4 ideas a week of ways we could make more money, but that doesn't necessarily mean we're going to do them. They have to be consistent with our strategy and consistent with what we want to stand for as a company. And none of that is an attempt to criticize cryptocurrency. It's just the philosophy that we have around whether it's the right thing for us to be offering to our clients and in our business.
Well, Walt, thank you so much for joining us.
Jen, thank you. Thanks.